This section, what we're going to be looking at is primarily valuation and analysis. We're going to be basically using qualitative is news, and quantitative data to assess the value of a company. And from there, we can then come to an assessment as to whether or not the stock price is fair, whether it is cheap, which is undervalued, or whether it is expensive, we call that being overvalued. All right? And there are a few key terms that we're going to have to go through. I have them in one article here. Okay, so there are 7 key terms that you're going to come across once you are looking at, say, any report on the company's performance. And these reports are released, they are actually mandated by the stock exchange that the companies actually release the performance over every 3 months. We call it their quarterly performance. Now, the quarterly performance is going to vary for different companies. The reporting dates will also vary based on when the company's financial year ends. So some companies match their financial year with the calendar year, others match it with tax season, and then others just randomly choose a date based on when the companies were incorporated. Alright? So any report, and I know you can't see them, I'm going to go through them. But any report that seeks to do an analysis of the company's performance is going to feature at least these 7 terms. The first one is revenues. And by the way, these terms are also the things you want to look out for. Typically, they form the basis of the paragraphs of the report. And we'll show an example in the form of Lasco manufacturing. So they normally start with revenue, also known as the top line. And it's called that because it is prominent at the very top of the company's cash flow statement. There are also 3 statements that you need to analyze when you're going to be doing a quantitative analysis on a company. The 3 statements are the statement of cash flow, the statement of profit and loss, and the balance sheet. And we're going to actually walk through each of these for Lasco manufacturing. And we'll also show what metrics we calculate. Sorry? Yes. Okay, right. So we're going to assess each of these. Now, in each case, you look at something different. In terms of the balance sheet, you're not necessarily going to be looking for necessarily high numbers. What you do want to see, however, is a consistent growth in terms of the shareholders' equity. Even if the company's assets go down, once the shareholders' equity is improving, it means that your company is becoming more valuable. Alright? So again, back to this. The first one is revenues. Revenues simply refer to all of the monies that the company takes in from its sale of its services or products. Alright? In some industries it is called the turnover. In some industries it is simply referred to as sales. Alright? If you're looking at a bank, however, you're going to see it marked as interest income or investment income. Alright? And in terms of revenues, what you want to see is for a growing company, revenues increasing from year to year to year. That tells you the company is selling more or it is raising its prices. Raising its prices is actually more important. A company that can raise its price actually has what we call an economic moat. An economic moat is a definitive value advantage that sets that company apart from its peers. It could be simple. It could be a simple thing such as a brand name. All right. The gross profit is actually the money that the company has left after it has taken care of the expenses associated with its sales. Meaning, if you're looking at a company that buys and sells cars, the gross profit would be the difference between how much it paid to acquire those cars and how much it was able to sell them for. Alright? After you look at gross profit, and can you imagine the trend you want to see in gross profit? Which way you want to see gross profit going? Oh, okay, great. What would be the net profit? Right, so it's a difference when you consider how much a company pays in other expenses. So a company might have, well, there's also taxes, naturally, but a company might have expenses related to just administration. It could be a legal fee. It could be licensing that they have to pay on a regular basis. And these things eat into the gross profit, and that leaves you your net profit. The most important line for the investor ought to be the net profit, because that tells you how much a company actually makes. Good case in point is Everything Fresh. Everything Fresh has over $2 billion in revenue, but the company makes less. Is it 100 or 10? I think it's less than $100 million, which means that they're keeping less than 5% of the amount that of the revenue that they're collecting. Everything Fresh has a curse we like to call cost of goods sold. For example, imagine if you are buying and selling yachts or planes. A yacht costs what? 30 million? And you're selling it for, let's say, 35 million. So while your revenues are huge numbers, your net profit are small numbers. There's a great story about two different companies, and in one case, the net profit so the two companies, one was selling high-ticket items like Bentleys and Audis, etc. They were retail. The other company was selling toilet paper. But when you look at the net profit of the companies, the percentage that the toilet paper company made was significantly higher than that of the high-ticket sales company. And you can imagine why. By the way, companies that deal in consumer goods or fast-moving consumer goods, they are the companies that are typically recession-proof. I say that in reference to what we talked about at the start of the class. The next term is the earnings per share. So earlier we spoke about the equity in the company, and we spoke about the stocks, we spoke about them representing ownership interest in the company. Every company has what we call the Articles of Incorporation, which dictates how many shares that company has distributed. For some companies, like Palace Amusements, it's only 1 million. For other companies, like Wigton, it's 11 billion. Alright? Now, the earnings per share, you can imagine, is going to be tied directly to the amount of shares you have. The earnings per share is a ratio between the net income and the total number of shares that are in issue. So you take the total net income that the company has, and you divide that by the total number of shares that the company has. Is this making sense? We're going to go to Excel and actually run some of these numbers, alright? But that's why it's called earnings per share. And then below that we have the market capitalization. Market capitalization simply means what's the value of the company on the market. That's all it means. And how you come to that number is you take the last traded share price and you multiply it by the number of shares that the company has in issue. So for example, Wigton, when it first came out, had a market capitalization of, what was it, 5 billion. They had 11 billion shares at 50 cents. So you multiply that out, it comes out basically $5 billion. And then lastly, you want to look at what the book value of the company is. Now the book value of the company is basically what the total assets of the company are as stated on the company's books, meaning on the balance sheet. So if a company owns, let's say, a car that is valued at $5 million, then it owns a manufacturing plant that is valued at $7 million. The company's book value is going to be the sum of all the assets that it owns. And you also want to subtract the company's debt as well. So you get, that's actually the net book value. Alright, and you'll see these as an example. Alright, so why do I mention those? Because they play into what is known as the price to earnings ratio for the company. The price to earnings ratio is a valuation metric, but it does far more than that. And I'll have to explain using an example. So the price to earnings ratio is a ratio of the company's current share price by its earnings per share. So for example, Wheaton had I think the last trading price was $1. Somewhere about there. I think it did close at $1, right? And then its earnings were 0.03. So that's 3 cents. Alright? No, that was just for a quarter. If you want to see what the total earnings are, you can project them into the future and say, okay, it made 3 cents this quarter. Wheaton is not expanding. Wheaton is not able to necessarily increase its revenue so easily. So you can extrapolate that 3 cents to 3 times 4, which is 12 cents. Alright? And I'll explain why I use Wheaton in that particular instance. Nathan, you're going to give us some insight into Wheaton afterwards, at least based on Nathan is an alternative energy expert, so he's going to be telling just a little insight on what's happening with Wheaton. So you would divide the price of $1 by the total earnings of 12 cents, giving you approximately 8 times. Alright, so that's a PE of 8. Can somebody calculate and what the exact value is? So your price is $1 per share, and your total earnings are 12 cents. So that's 0.12. $8.33. Perfect. By the way, just because of Wheaton's nature, we consider that 8 a fair value, and we'll get into what is fair and what is not fair for different companies. Okay, so now that we understand what those terms mean, we can now look at what an earnings report would look like and what the company would actually write. I'm going to use this one. Okay, so this article is you can't see that, can you? Okay. Typically, in reporting on a company's performance, what we'll do is we'll simply take the key points and put them at the very top. A person who is looking to do an analysis simply needs to look at those numbers to get a quantitative idea as to the performance of the company. This standard was developed by Bloomberg, Reason being, there are, I don't wish to misquote the number, but there are hundreds of thousands of stocks listed on the various exchanges that Bloomberg tracks. And so it needs a concise way to deliver the information to analysts who will actually use that in managing people's funds. So the key points from the lab's Q1 earnings were as follows. Their operating revenue, which is the same thing as revenue, grew by 28.33% to 334 million. Remember, this is for the quarter, all right? Gross profit grew by 24%. By the way, using this, when I'm through, I'll ask a question, but using this, what direction would you say the company is going in, okay? So, gross profit grew by 24% over the comparable period to 124.9 million. Net profits were up 7.8%, and the stock price increased 300% over the IPO price. Is there anything that jumps out at you looking at those statistics?
Stock price.
He said that the stock price is advancing at a much faster rate than pretty much anything else. There's another key insight that you ought to extract from those four statements. Exactly.
So we're seeing that in terms of the profits, the net profit is about 2 or 3 times less than the actual advancing of the gross profit, or as it really is the revenue increasing.
Right. And that's important because oftentimes a person will see that a company has increased its revenue, and these things make headlines, by the way. So when media houses like to sensationalize things, when they are publishing articles related to different companies, what they will do is they will either take the biggest positive number and make that the headline, or the biggest negative number. And that's why you have to actually look through the entire report, because it will skew the actual, what do I want to say? The perception, exactly. So you can create a different narrative based on which headline you choose. So if I wanted to create or inspire a positive sentiment in the market, my headline would read, "The lab increases share price 300%. Okay? Now we extract the past, so people are going to assume that, hey, this is going up, it's going to continue to go up. Alright? If however I wanted to inspire a negative sentiment, my headline would read, "Stock price up 300%, but net profits only up 7%. It's a whole different story. Same facts. Alright? Alright. So, and then I was mentioning earlier that you will take most of those key terms and each of them will form the basis of the report. So we first delve into the revenue growth. Then you look at the cash flow to see what the cash on the company is. You see earnings per share right above that, which is only 8 cents. Then you take into consideration, well, in this case, the lab's IPO funds are not included in its accounting. You can also, this is called financial gymnastics, but you can swerve perception by deciding what to put in your financial report, and you can actually dictate when you record certain happenings in your company. For example, if I know that I have a public company, and SSL Venture Capital would be a good idea, and I know that, okay, we lost 80% of our revenue, or worse, we weren't able to identify revenues, which is what SSL did. My quarterly report would talk more about the fact that we acquired a 50% stake in a new company, and I'd focus on that. Alright? A balanced analysis is going to give you both the positive and the negatives about a company. And that can be hard to find. And of course, talk about the stock price performance, and then there is an opinion. Okay, and this is basically the standard in terms of how companies actually report on the performance. So you see here, this headline reads, Lasco Manufacturing profits in the future. Without reading the headline, I can tell you what is happening. Without reading the story, I can tell you what is happening. They're currently not doing good. They're spending a whole lot of money. And I'm going to send you the article, but good job on picking that up. So what the angle that the article is posted from is that they're spending all of this money to make more money into the future. And of course, to inspire a positive sentiment, we focus on the future. Alright, so having talked about that, what we're going to look at next, and in the interest of time, is we're going to look at some of the key ratios that you actually need to be able to calculate in order to assess the performance of a company. So these would be the three major statements. There's the statement of financial position, which is the balance sheet, the statement of profit and loss, which is the income statement, and the statement of cash flows. And okay, so we can see that, right? Okay. I guess I can make it larger. Okay. So in this case, this is Lasco Manufacturing, and Lasco Manufacturing's year end is in line with tax season. It ends in March. Alright? So what we're looking at here is a statement of cash flows. And what you want to do is it's fairly straightforward actually. You just want to see from the top line activities that the company's cash flow are going in the positive direction. That's ideally what you're looking for when you're looking at a company's statement of cash flows. You also want to look at where that cash is coming from and where it is being spent. So here, here we see that the net profit had increased from 2010 to 2011. We also see a decrease in the interest income. How I basically assess these is I look for what we call the big ticket items. So you're looking for the big numbers and then you want to identify what they represent. So, for example, if we saw where, well, this is a good one, tax expenses went up by near 100%. Do you know why that was, by the way? Sorry? Yes. So, Lasco Manufacturing was listed on the junior market. When you're listed on the junior market, for the first 5 years, you pay 0% in terms of taxes. In the second 5 years, you start paying 50%. Okay? So, in this case, they had moved from the 50%, from the 0% to the 50%. Hence, the amount that they paid in taxes went up significantly. What else are we looking at? So, we look at that. And there's not much else that's particularly interesting here. You can see where the total taxation paid went up significantly by what? A factor of 3, almost. This is another big ticket item. So this was an issue of shares net of expenses. So basically what the company did was it issued shares in order to finance new activities. Anybody know of a situation that's currently going on like that? Exactly. So the company is now issuing new shares to raise capital such that they can embark on expansion activities. Okay, what else do we want to look at here? You want to look at the company's debts, but this is not typically where you look at that. You normally look at it in the balance sheet. Alright? But this tells you exactly where the money is moving. That's why it's called a statement of cash flows. Alright, so let's look at the company's. You can see that you can see here that the cash position of the company at the end of the year was down by about 20%.
Question.
Yes, sure.
So, where they have the investment plans, that's all it is.
Down?
Yeah.
Cash flows from investing, okay. So there's interest, purchase of land.
Right, it's almost 100,000, right?
Down.
Right, no. So, right, so that's what I said the figure. So, if you go up now, all the way down. The same line that you're at before when you're comparing 2 years.
Yes.
Cash flow position of 2 years and the 2 hours.
Yeah.
The figure was 400, right? Right, so that's almost
A direct correlation between the two. So you see where the money was spent, basically. Alright, so typically the cash flow statement, as I said earlier, only tells you where the money is flowing. We don't really use it to do anything else. The two statements that we really use to do analysis are the balance sheet and the income statement. So let's look at those. So balance sheet. Okay, so on the balance sheet is actually split into 2 parts. Well, it's actually 3, but you can consider it 2. The first is the company's assets. That is what it owns. The second is the company's liabilities. That is what it owes. Alright? And the difference between those two gives you what we call the shareholders' equity, the net of worth of the company. So ideally, what you want to see is this one as intuitive as well? You want to see a company increasing assets and doing what with its liabilities? Decreasing them, exactly. Such that the shareholder equity increases. The work